Hey everybody, it's Lawrence from financialthing.com. It's our Thursday evening. If you're in the UK, if you're in the US, you'll be in the afternoon. Wherever you are in the world, welcome. It's our peer-to-peer lending based live stream. Don't forget 2 streams every week. Tuesday is stocks and crypto, and we do peer-to-peer lending now on a Thursday evening. And we have another guest. It's been a week full of guests. We had a cryptocurrency guest on Tuesday, and now we have a peer-to-peer lending company guest today. We have Jatin from, hope I didn't butcher that name, from Shojin Property Partners, and they are a London-based peer-to-peer lending company that specializes in several different, I think I would call larger scale projects. Let me show you their website right now. If you want to go check them out, you can do that at shojin.co.uk. And thank you to everybody who's joining us. It's been an exciting week as far as turmoil in the stock markets and what's going on, but I think this too shall pass. Let me turn my light on. Hold on one second. Forgot that. There we go. So yes, welcome to everyone. Let me go ahead and bring I want to say his name right. I always get this right. I'm going to call him Jatin. He's going to tell me if I'm saying it wrong, but let me go ahead and bring him in. Here we go. Can you hear me okay? Maybe not. Hold on one second. Let me see if I have him muted. Oh yeah, I do have him muted. Hi Jatin, you are live on YouTube. How are you today?
Hey, very well, thanks. Great to be here.
Thank you for spending the time to join us. Let me turn this on. Let me know if you can hear Jatin okay. He's coming to us from London town, deep in the woods of, hang on, let me remember. And if you hear a noise in the background, that is just rain lashing against the window. We have a thunderstorm going on, so if you hear it, that is what you're going to hear. But yeah, let me know if you can hear. Tell me, Belsize Park.
Belsize Park, yeah.
Belsize Park,
That's
okay.
the one.
So yeah, thanks for joining us, Jatin. And we're going to talk about peer-to-peer lending today. We're going to talk about Shojin. You are one of the companies that people have asked. Oh, did you hear that? That is live. That is live YouTube. That was a big. If I showed you outside right now, you wouldn't believe it. It looks like a mini hurricane. Hopefully the power doesn't go out. I'll tell you in advance if it does. It's probably going to destroy the stream, so I'm sorry I can't control the weather. It's just the way it is. But yeah, hit the like if you can, everybody on the stream who's watching. And if you have any questions, put them in the chat. We'll do a short Q&A at the end if we can survive this storm. And so, Jatin, tell me a little bit about what is your background prior to being a founder of Shojin?
Sure, yeah. So I was actually an investment banker for about 12 years. I was with UBS. I was in London. I was based in New York for a few years as well. I was structured solutions, bond sales, that type of stuff. It gave me a lot of kind of the foundational knowledge I needed to go off and launch Shojin later. But yeah, that's what I started off doing. Quite early in the process, though, I invested in real estate, and it must be an Indian thing. I was raised with this idea that you don't with your first paycheck you don't go off and buy a nice flashy car or anything. You invest in property. So I took that to heart, and throughout my time at UBS, I was investing in real estate on the side.
That's the dog. She likes it. Hang on.
She likes a bit of real estate. There you go. That's good.
It's live today. I don't know what's going on. The dog doesn't let me close the door. She doesn't like the thunderstorm. So when you said investment banker, there was this little voice in my head that went boo, because the banking sector does not have the greatest reputation, but I'm sure you were one of the good guys.
I was one of the good guys, exactly. Yes, so I didn't cause the crash.
You didn't. You weren't the Lehman Brothers type then. So, do you personally invest in peer-to-peer lending yourself in other companies or other peer-to-peer lending? Did you do any due diligence that way?
Well, when we started Shojin, so really the way it happened was because I was always invested in real estate. The way we launched Shojin wasn't actually starting with peer to peer because we'd always myself and my co-founder we'd always invested in real estate, and a lot of people we were surrounded by in not just banking circles but professional circles generally. A lot of people were kind of listening to kind of the kind of things we were doing in the property space, and it was really easy stuff, like basically buying rental properties and things for student lets. But people loved the idea of it. But when we told them how easy it was to do, you realize a lot of people didn't have the time nor inclination to do it for themselves. And you realize, people are busy with their own lives, and they've got to stay focused on that. They're very smart in their field, and a lot of people don't really want to venture outside of that. But a lot of people started asking us if they could invest alongside us in the things we were doing. And that's really what started Shojin. So we were working, we weren't a peer-to-peer to begin with, right? So we were taking in money from high net worth individuals, pooling it together with our own cash, investing it into real estate, high yielding properties, renovate and flip, and then full-blown ground-up construction. And then at a certain point, we realized that actually construction development is a lot of hard work, and the reason we were able to do it is because the co-founder's background is in construction, so it was a perfect match. We'd be able to do the due diligence on projects and distill down the project details and the risks and everything, and then structure it financially to optimize the returns and then present it to our investors. So we had the best of both sides. But we realized development's not fun. I don't care what anybody says. Well, maybe for certain people it is, but to me, I didn't enjoy it. Simply because it's a complete shift. When you're working with building contractors, it's very different to working with bankers. Nothing wrong with it. It's just a very, very different approach. So what we realized was, though, that the model we created could actually be used to back other developers, because there are developers out there who are fantastic at what they do. They're great at finding sites, and they're great at carrying out the project and selling the scheme and so on. So we started looking at other developers' projects, and the thing with a lot of developers is when they first start off, they, like any other business, they reach out to friends and family to raise a bit of cash, and then they borrow from the bank, and then they do their first project, and then they'll start doing bigger and bigger projects, and soon they'll outgrow their friends and family network. So there's this kind of funding gap, like there is in any normal business space. There's a funding gap. Once you need 2, 3, 4 million pounds in equity, it's too big for your friends and family. And so for them, they had nowhere to go for the capital. So when we started saying, look, come to us, bring us your project, we'll take a look at it. If it meets our criteria, we'll provide the funding. We'll agree a percentage, in terms of profit splits or rates and all of that, but it will be fair on all sides. And then what we will do is we will bring our investor base with us, and we'll fund the project. And that really started taking off. So that was brilliant. It was only really then that we thought, you know what, our investors love what we do. They're generating fantastic returns. We were generating kind of 15 to 25% type returns for investors, depending on if you're going in as equity or kind of slightly lower risk as a fixed rate debt, which sounds high. But actually, in development circles, it's normal, right? This is the weird thing. A lot of people think, oh, those returns are too high. They're not. They're actually normal. If they were any lower, that's when you'd start worrying, because you should be making a lot of money in development, right? There's a lot of work involved, and there's a healthy profit margin. So that's when we thought, you know what? There's an opportunity here to open this up to a much more broader market. And that's when we started looking into the peer-to-peer kind of crowdfunding type environment. But the interesting thing was, I test drove a lot of other platforms, and the weird thing I found was nobody was operating in the space we were operating in. And it's because most people understand standard peer-to-peer lending, low risk, first charge, all of that. And that's simple. And because it's so simple, every man and his dog set up, in the last 10 years, they set up bridge lending firms and things like that, because it is so easy. If you're at 60% loan to value, really, where's the risk? So we found everybody was focusing there, and it was a complete race to the bottom, because all this private equity money was flooding into the senior funding market, which is why, if you look at most peer-to-peer lenders, they've ended up going for institutional funding, because it's cheaper than going to the crowd. What we realized was the part of the market we were focused on, because we'd done development, we're very comfortable there. And not many people operate in that space because it's a hell of a lot more work to do due diligence when you're in the equity position, because you are seriously at risk because you're at the lower end of the stack. And so that's why we started focusing on development funding, and we launched this online platform because we realized that globally, lots of people are going to want to invest in this kind of thing, and that's what got us to where we are now. So, in its original form, 2009, but it wasn't a regulated platform at that point. We went live as a regulated. We applied for our license in 2015, and we went live in 2017 as an online platform.
Okay. I think I have my mic muted then, but I was just asking Jatin when they released their first loan on Shojin. So a couple of basic things. What is the minimum investment amount somebody wants to invest through Shojin currently?
So we've set a minimum of £5,000. Now, the rationale behind that was, in an ideal world, we'd love to be in a position where everyone could chuck in £50 each. But the reality is, because of the part of the market we focus on, our typical fundraise is between £2 and £6 million. If you're trying to raise, say, £4 million and everyone's putting in £50 each, it's going to take you a long time to get that filled. So we decided to work top down. Now, historically, the kind of people that would have invested in development were people at family offices who could drop $1 million, $2 million at a time. They're covered. But the next tier down is what I call the global mass affluent. They're people that have investable funds of anywhere from, it could be a couple of $100,000 up to a couple of £1 million. They're that in-between bunch who don't have access to these types of alternative investments. They're stuck with bog standard investments and pensions and all of those things. And we realized that was, firstly, it was the low-hanging fruit. These people are they really want to invest in this space. There's 400 million of them. Let's start with them. And actually, and I'd love to say we thought of that ourselves. We didn't think of it ourselves. And while I hate to use the name of another investment bank, but Goldman Sachs thought about it when they introduced Marcus. It's the reason everyone's tapping into the middle market, because the top end market is done. The real the opportunity on the table is the middle market, which is completely underserviced.
Mm-hmm. What is the current size of Shojin's loan book right now?
So currently we've got right now we've got about £30 million out in junior funding, which is funding about 160, 170 million pounds worth of development. So remember, we're in kind of equity mezzanine space at the bottom. Mm-hmm. You've got senior funding on top, and then the overall value of the project. So a little bit goes a long way in our space.
Okay. What is the average return that somebody could hopefully expect to receive if they're investing through projects? Or maybe give me the historical returns, because
Sure.
That can change, I know.
Yeah, of course. I mean, but then we have certain parameters we work to. Because there's not that much competition in our market, we can pick and choose which projects we go with. So we look for lowest risk with decent returns. So we tend to target, if someone's investing in equity, which is on a profit share basis, they should be earning somewhere around 25% per annum. If someone's investing in lower risk mezzanine, which is second charge, is much more secure, they should be getting around 14, 15% per annum. Mm-hmm. And then you've got the bit in between, which is things like preferred equity, which is where you're sitting lower in the capital stack, but it's structured as a fixed rate return on a priority basis. That'll be around 20% per annum.
Okay. Yeah, and we'll definitely talk about risk, because obviously with any investment type of sector that you're in, there's going to be risk involved. So everyone needs to understand that when you're making percentage returns that are high, or you are going to be facing some calculated risk. So we'll definitely talk about that with Jatin. What I found very interesting about Shojin was that you co-invest in every single project. So you've got this skin in the game, correct?
Mm.
Talk to me a little bit about that, and tell me, is that based on a percentage amount? Because there's some peer-to-peer companies that have, they do it by percentages, or is it based on what you feel about the project? You go in heavier. How does that work for you?
Yeah, so let me start with the basic premise that when we looked at what was happening in the peer-to-peer world when we were launching, we realized that the thing we didn't like that was happening in the industry was the same thing I didn't like about what happens in the pension industry, the bog standard investment funds. And that's that the person who's making a decision on investing your money has no skin in the game. If something goes wrong, they don't really lose anything. The fund manager at my pension fund probably still drives around in a Ferrari in the last few years when I've been taking hits on my pension. So that was what annoyed me. And the asset management industry is one of the last industries to be really shaken up by technology. So that's if we put a target on it, that's our target. But what we realized was, if we look at all the things that are wrong in the industry, let's make them right in what we do. So first of all, we said, well, we've got to invest in every project. That's a given. But the other thing is, what about the fees? Well, yeah, we actually never used to charge any fees. It was all back-ended. And then we realized actually that was a bit silly because we've got to have operating capital, right? So then we started charging some fees, but it's a small amount. It's charged to the project, not to investors. That doesn't really make us much money. It's still the back end that makes us the most money. But I thought it's small fees, so you're not eroding returns from the beginning. You're co-investing. The co-investment used to be 10% of whatever the amount, the total amount of funding we're providing is. We had to reduce that to 5%, simply cash flow reasons. So because remember, we're tying up a lot of money in each project now. So nowadays it tends to be between 3 and 5%. But the other co-investment that we make, which a lot of people don't really think about, is we don't charge any management fee. But throughout the life of the project, we attend all the design team meetings, all the professional team meetings on site. We go to site regularly. We monitor expected versus actuals on cash flows and timelines. Basically, we are looking for anything that could upset the returns on this project, and we look to set it right early on. So there's all of that oversight that goes on, which we're not charging for. So theoretically, that's another co-investment. And then at the end of the project, we only make money when the investor makes money, because the way we do it is we take a percentage of the returns. The returns we quote to investors is what they get. That's after we've taken our bit. So if we're charging, let's say, if on equity it's about 35% per annum is typically the kind of level we look for, we'll sell that down at 25%. We'll make 10%, a very handsome return, unashamedly so, because we've done a hell of a lot of work to get to that endpoint. But putting all of these things together, I think for an investor, when you go through it all, it just gives them that comfort and confidence that actually, you know what, we are on the investor side. We're looking after the investors. We're treating their money as if it's our own, and we're making sure that everything performs as it should.
Okay. Obviously, performance is a big deal when it comes to peer-to-peer lending. You've seen some of the failures that have occurred, I'm sure. And
One project. Yeah. Yeah, sure. So
sorry, give me 1 second. I was muted again. I don't know why. This thunderstorm. So when everything starts going crazy, I was hitting the mute so that stuff wasn't going to come through. But let me ask you that question again.
sure.
We talk a lot in peer-to-peer lending about defaults, what's going on, with some of the companies like Landy, Funding Secure that have lost business. The business gone into administration because of bad loans were written. And I was looking through Shojin's past projects, and everything looked really good, except for, can you hear me? I think everybody should be able to hear me. Hang on. There's a little bit of a delay on the chat, so they're asking me to rewind. Yeah, we have about 35 people watching live now. Don't get nervous. Hang on one second. Tell me if you can hear me out there. I hope you can. Should be... Hang on, wait. Still no sound. Hang on. 1 second. I think I know what's wrong. Tell me, everybody, can you hear me now? Loud and clear, okay. Yeah, as I was saying, so we have these default issues within peer-to-peer lending. It's been a thorn in the side of the sector. I was looking through your projects, and I noticed there was one bad apple in the crate of good apples that went badly, and you wrote on there that investors has experienced some capital loss, and that you offered Shojin shares to investors as compensation. So I wanted to ask you if you give me a quick description about what happened, and what also did you learn about that project, and what would you do differently in the future, or what are you doing so that doesn't happen again?
Sure. Okay. So let me give this a two-part answer, because the first one I'd rather address is actually, you mentioned some of the others in the industry that went pop over the last few years, and straight off the bat, why? Well, it's not so much that it couldn't happen to us, but why is it that we're differentiated from that? And the immediate thing to notice is that the ones that actually did go down were all senior lenders. They were in a part of the market that is the most competitive. And as I said, over the last 10 years, to give you an example, 15 years ago, if I wanted to take a bridge loan in the UK, it was bog standard, 55, 60% loan to value, 1% per month, 12% a year. That was your bog standard. Today, the same bridge loan would cost me 6.5%. That's how much the rates have come down. Meanwhile, mezzanine rates have remained pretty much where they were at kind of 15 to 18%. Equity rates have remained pretty much where they were at about kind of 22 to 26%, that kind of range. So what's happened is a lot of the pressure has come into the senior funding space. Now, a lot of peer-to-peer platforms launched with this idea of providing safe loans to investors, but they were providing pretty decent return, 8-9% in some cases. But the problem is, if a developer, if a borrower can go to the market and get funding at 6.5%, why would he go to a peer-to-peer lender, which has a lot more uncertainty? Well, the only reason to go to a peer-to-peer lender then is because there's something quirky about your deal. There's some risk elements that a mainstream lender will not accept. So we again recognize that very early on. And that's part of the reason we stayed away from the senior space. It's a race to the bottom. And the only way to generate decent returns is by taking on disproportionately more risk. Somebody invests thinking it's a low risk first charge investment, but actually it's not that low risk. And we do some mezzanine deals, so second charge deals, which in my view are less risky than some of the first charge deals that I see in the market. So, and because of the space we operate in, the profit margins are much, much bigger. So that means we get to, and there's not as much competition. So unlike a lot of the lendies who had to gun for, they had to deploy cash, they had to do more deals, they had to grow that loan book because that's how they were going to make money. It's a volume play. Ours isn't a volume play. Ours is a quality play. It has to be because we're in a more risky space. So we do fewer deals. And because we don't have much competition, we get to cherry pick the deals that we think where the returns are disproportionately high compared to the risk. And a simple example I would give you on that is, 6.5% is what one would earn on a bridge loan today. We're doing a mezzanine loan today, which sits within the loan to value parameters of a bridge loan, but we're mezzanine. We're behind a very conservative first charge lender. and that one's generating 13% for investors. Double the rate on a typical bridge loan. Is it double the risk? Absolutely, categorically, no way. It's probably about 10% higher. So it's almost I won't call it an arbitrage, but we're operating in a very inefficient market, which is where the margins come from, where the returns come from. Those guys were operating in a very efficient market and still trying to generate the high returns. It's almost impossible to do. So if you look at peer-to-peer today, those in the senior space have either closed, they've gone into an administration or something, or they've started taking institutional funding lines. Because why would you not? If you're getting institutional funding at 5%, why would you crowdfund it at 7 or 8%? Doesn't make sense. So that's what's happened over there, and that's why our space, almost relatively weirdly, is safer in that risk.
Yeah.
Now coming back to the bad apple. Over the years, every single deal that we've done there have been delays. There are often delays on real estate development, but the overall returns generated for investors have pretty much been where they should be. And we have a lot of mechanisms built in to make sure the annualized return stays pretty much where it should be. But we had one project, which was a fantastic project, a landmark project near London Bridge. It would have been the first central London co-living scheme. And we had all the pre-applications done with the council. The mayor's office was involved. They were all really, really supportive. So anyway, we funded it. The developers worked on the planning. They had all the consultations. Everything was good. And then they submitted the final planning application. Sometime around then, when the council was supposed to be considering the application, our good old friend Jeremy Corbyn came on the scene. And at the time, he was kiboshing a lot of development schemes around London. He basically wanted to see more social housing on that scheme. He didn't want to see co-living. He hated co-living. But because it was the local council was Labour controlled, he put a lot of pressure on them. And the mayor's office, Labour, he put a lot of pressure on the mayor's office. And basically, the council and the mayor's office did a U-turn in terms of support, but they never rejected the scheme. What they did was they dragged it out until the scheme basically ran out of money. Now, the thing we learned from that is we did all of our due diligence exactly as we should have done. The one thing we didn't factor is political risk. And what we ended up doing, it was quite early in our journey. What we ended up doing was, we didn't have to do it. We don't want to create a moral hazard, say we're going to bail out every project that fails. But it was early in our business life. We had raised money at a valuation of 28 million already. So myself and the co-founder owned 40% at the time. We basically gave up some of our shares to compensate those investors that lost money. We didn't have to do it, but we did it. We felt it was the right thing to do at that time because those guys had supported us through that whole process. They didn't pressurize us in the process, but most importantly, those relationships were crucial to hold on to. And I'd say 90% of those investors have gone on to invest in more projects. So it paid off in the long run. I say it paid off. It paid off in terms of making the share distributions. But the biggest shift or the biggest change we made as a firm was we stopped backing schemes that were unconsented, that didn't have planning permission in place. It's too much of a risk. Because politically, the reason we have a shortage of housing in the UK is because these politicians cannot get their act together. And so despite everything they say in the government about encouraging more home building and supporting more planning, they can't get their act together. So as a result, you're always going to have political interference. By avoiding anything that doesn't have planning permission, we've actually got rid of that risk altogether. Every scheme we now fund has planning permission.
I would say that's a good move, Jatin. And what you've done is sort of flip my brain a little bit about what I call second charges, you call junior charges, and sometimes mezzanine. Because I was always under the impression that most of the projects I've looked at on other platforms that were second charges, the interest that was being offered just never really matched up with the risk that I felt I would be taking to take a junior charge. But what you're saying is, in order to get better returns, as long as you pick the right projects, that being the key, that you can actually almost be taking only a little bit more risk to get extra returns to really get those juicy amounts that you're talking about. So I found that very interesting. I mean, thank you for explaining about the loan that didn't go so well, because a lot of companies, they've been hesitant to take that on. I did have to ask you this though. While despite that you gave investors shares, what can they really do with that? I mean, how does that really compensate them?
So there's no immediate compensation because they're not liquid, right? So they can't sell them. But we're giving them something that we know has value. They can say no, but obviously nobody did say no. Nobody would say no. Why would you? At the end of the day, we didn't have to do anything, right? Because we'd done everything properly. In fact, we even had to check that everything happened as it should with the whole planning process as well with the developers. We had a whole review done, a legal review done on that as well, and that came back clean. Everything happened as it should. We could have walked away and said, look, it's just one of those things. It's the risk you take. But we felt it was the right thing to do morally from our perspective.
Yeah.
I don't know if we do it going forward, because it creates a moral hazard, as the term has been used before. So we don't want people to think that we'll bail out projects. But that was too early in our journey to, if we hadn't done anything, it would have left a massive black mark on the firm, and we just didn't need that.
Yeah.
So the nice thing for investors, though, is that we've recently raised, we're actually still raising Series A, but we're raising at 50 million. So actually those guys are, technically on paper, they've made a profit already. And at some point there will be a liquidity event, at which point they'll be able to sell their shares. So it's not the same as cash in the pocket immediately, but actually they've got something of value.
Yeah, that's definitely fair enough. I'm just scrolling through some of the investment opportunities that you have on Shojin's website, and I'm seeing some projected returns here: 22.5%. 14%. We got one in Malaysia. We're going to talk about that. That's ranging up to 38%. So these returns, they're quite high compared to, here 20%. So we do have to talk about risk. There being, what exactly are the risks that people face to get those types of returns through Shojin?
So look, first of all, I think we've got to start with the basic premise that these aren't exceptionally high returns. These are the returns that people have always got. Maybe just not you and I. Well, I don't know about you, but certainly not myself.
I don't know. Mine's usually in the negative. My track record of crypto and stocks, I tend to sometimes hit the red. But yeah.
Yeah. Well. Look, if you go back, even if now, if you look around the market, the fact is, if you have money, let's say you're a family office. And a family office, for those that don't know, obviously, it's a wealthy family, made money in whichever sector. They've got a whole load of cash, and then they have almost like their own in-house asset management team to deploy the cash. And they've been making these returns for years. The single reason why the rich get richer is because they have access to the type of opportunities that the rest of us don't have. The returns that you're seeing on there, they are there. They're the normal returns. They just weren't available to us. Now, if you look at, for example, one of the projects there, the 22.5%, and let's just for a moment compare it to an online first charge loan, right? Let's say you're getting 7%, right? Let's keep it simple. You're getting 7% on a regular peer-to-peer first charge loan. You're getting 3 times the return. The question is it 3 times the risk? Now, if a project is bad, you don't go into it, whether you're going in first charge, second charge, you just don't touch it. So if you eliminate the fact that, if it's a bad project, we're just not touching it anyway, it's a good project. So all the due diligence has been done, the sales values. In fact, the bill price came in £1.4 million lower than what we had in there. We're always very conservative with our numbers. Developers sometimes don't agree with it, but we say, look, this is where we're coming out. When we do our due diligence, by the way, and actually, I don't know if I've mentioned this, but we have a very, very detailed process that we go through, almost like 250 different areas that we check. we assess the risk, we look at, is it a naked, is it an open risk, or can it be mitigated? If it can be mitigated, we do, whether with insurance or things like that. But then once we've done all that internally, we then get it independently verified, but by cost consultants, valuations, and all of these things, because you can't rely on any one or the other side. I've seen valuations that have been grossly off in the past. So this way, we've done all the work ourselves, and then there's an independent valuation. And if they're both pretty much saying the same thing, then we know, okay, the numbers all stack. So when you look at the risk on a project like that, I mean, that project, for example, it's an existing building. It's a conversion of an old office block into residential. Now, the permits are all in. In fact, the work has already started. But what I love about that project is it's easy, right? It literally is internally partitioning that building. It's a modern building, doesn't need utility upgrade, doesn't need communal area upgrades. It's brilliant. The return of 22.5% is actually too high for that type of project, where the risk is actually a lot lower. And the only reason we've got that return on there is because we have our own internal parameters in terms of where we are going to in terms of loan to cost and loan to GDV. GDV, gross development value, just in case anyone's unfamiliar with that term. So we look at it on various parameters. And then we will say, okay, for example, if we're going to provide equity for that project, if let's say there's a £10 million project, senior lenders putting in 6.5 million, and the developer's only got £500,000 to put in. Well, we will then put in about maybe 1.5 million as equity, and then the rest of it as mezzanine, which sits on top. The equity is the riskiest part, and that's the bit where you share profits typically. The mezzanine is less risky, where you get a fixed priority return. What we did in that project is, and this often happens when it's a very, very lucrative project, is we went in saying our usual thing to the developer, which is, we'll do it. We expect a 50-50 share of profits with a 35% per annum hurdle. And anything above 35%, you can keep 75% of it. So we give the developer an incentive to outperform. But if it falls below 35%, you've got to give up some of your returns to get us back to where we should be. What that does is two things. It doesn't just deal with the return side in terms of the end sales price and things like that, but it also deals with time. Because if a 2-year project becomes a 3-year project, that's your biggest threat to the project on an annualized return basis. If you earn 20% per year on a 2-year project, and that becomes a 3-year project, your annualized return drops. Right?
Yeah.
So that's what we're really trying to protect against. Anyway, so we're talking to a developer, and we're saying, right, we'll give you all the money that you need, 35% on a 50-50 profit share. The developer now looks at his project. It's insanely profitable. He's thinking to himself, do I want to give away 50%? Now, if I was in his shoes, no, I wouldn't want to. So he comes back and says, look, what if I offer you a fixed rate return? Not 35%, but 30%. But I give you a fixed return in priority ahead of my profit and ahead of my capital. And weirdly enough, that's exactly what we want. And I'm not saying we manipulate the situation. The developer works it out for themselves. But actually, for us, I'm an ex. I used to focus a lot on risk at the bank as well. And for me, giving up a bit of upside for a hell of a lot more downside protection, well worth it. Mm-hmm. So now we're getting, in that one, for example, we're getting 30% as a fixed return, priority ahead of the developer taking capital or profits. Also, we managed to get a personal guarantee in there for £600,000. So we so heavily secured our own position, but because we're getting 30%, we're still selling it down at equity rates, 22.5%. Investors should not be getting 22.5% on that. If I was greedy, we could probably sell that down at 15% because the risk is so much lower.
Yeah.
But we don't believe in greed. We believe in passing on the benefits of our negotiating.
So one question that sprang to my mind is, if you're doing a profit sharing with a developer, some developers I've met are not exactly on the up and up. How do you know that they're being truthful about what they're actually making?
So we honestly, when you look at the level of due diligence we do on everything, it's insane. But we also, if we are on profit share, for the last few years, actually, they haven't been profit share. They've always been this preferred equity kind of position. So it hasn't really bothered us. But When we did do it, we would go as far as monitoring their accounts, getting audited accounts, monitoring their cash flow. In some cases, we'd even have access to their bank account to see exactly who they're paying and to check there are invoices coming in against those. But then we would also, because we visit site on a regular basis, we check that that actual work has been done. So we do that, but we also have a monitoring surveyor who does that as well. So the monitoring surveyor, again, if you're not familiar with the term, or if anybody isn't familiar with the term, is a quantity surveyor who acts for usually the senior lender, because they're drip feeding the development funds. So the way it often works is the developer does, say, £500,000 worth of work in a month. At the end of the month, they'll call in the bank. The monitoring surveyor will come in. He'll look at, all right, well, your bathrooms are 30% done, so we can release 30% of your funds there, and so on. Your flooring is done X percent, and so on. And they'll come to that £500,000 figure, and then the bank will give you the money. We have the same monitoring surveyor report to us as well. So we do our own assessment. We have them report to us, and then we also look at if there are any differences between the two, because it has been known, even for monitoring surveyors, to move numbers around. So we want to know exactly what's going on site. So this way you've got both sides kind of playing into it. But you're right. That trust element is crucial. But one thing I've learned in life, in business, is trust is all well and good, but when you're looking after somebody else's money, you've got to scrutinize the hell out of it, the actual cash flow, the process, and so we go through that with a fine tooth comb constantly.
Okay, that makes sense. Let me ask you a little bit about what you think of the peer-to-peer lending, sector in general, where it is. We've seen this sort of contraction of companies that have sort of either closed their doors or gone into administration. Are you hopeful about the peer-to-peer lending sector in general? Do you think it's going to expand, or just, there'll be a few quality players in the market where people can come put their money?
So I think there's two things to consider here. Firstly, we have seen a lot of firms exit the market, and that was partly driven by the regulators, because pre-COVID there'd been a few high-profile failures, as we know, and then the actual head of the FCA left to become the governor of the Bank of England, Andrew Bailey, and a new guy took over. His role, or his view, was that he needed to clean up this industry. Just as they were starting to interrogate most of the industry, COVID hit, at which point the FCA absolutely categorically panicked, because the last thing they needed was peer-to-peer firms blowing up. So everybody got heavily scrutinized. I mean, I think I spent most of 2020 talking to or responding to regulators. But during that time, they basically they pretty much shut down half the industry, right? They shut down so many platforms. And while I don't think it's their intention, but it is kind of what is happening, is from all of that, the ones that remain, not necessarily saying that they're all brilliant or perfect, but they've proven themselves, they lived through the scrutiny, the enhanced scrutiny of the FCA. But also, I think no small firm could have handled what we handled in 2020. The amount of time and effort and money that went into dealing with it, most small firms can sustain it. Most peer-to-peer platforms are small firms, which is why they shut down in the end. So what remains is a number of firms that are much better capitalized. They've got the manpower to do exactly what needs to be done, to manage risk, do all the right things. And while I don't think it was the FCA's intention, you can kind of see how there was a bit of a plan, because they haven't got the manpower, the capacity to monitor so many small firms. They don't make enough money from regulatory fees to do that, and they're stretched. It's easier for them to monitor a few larger firms, and that's pretty much what's ended up happening. So I think that's the first thing. That's the rationale behind the kind of big cull in the market. Not because the market doesn't work, but simply I think the regulators just couldn't deal with it all. But also, if you imagine there was a maturity happening in the market, peer-to-peer crowdfunding had been around for several years. And really the weaknesses were starting to show, which is why you had failures with the likes of Lendy and so because there were weaknesses in the market. There was a real lack of, I wouldn't say a lack of oversight, but not the right kind of oversight. But the second thing, and this bit I think is even more interesting. Pre-COVID, we'd spoken to a number of platforms about working together, because you realize it's such a fractionalized market. It's a very fragmented market, and individually, each platform was doing the same thing that the other platforms were doing. The regulatory cost, the accounting cost, the platform cost, the tech cost, the marketing cost, and it's unsustainable for a whole load of smaller firms. But what if we work together? And what if we work together and we work together by standardizing a lot of things to make this product more of a mainstream product, right? One of the biggest problems right now today is you can go to our platform and you can go to 5 other platforms and you'll see everyone using different terminology. You won't be able to compare products, right? Because there are so many nuances in each of them. So what we said is, why don't we just work together to make stuff standardized? Because that will then actually grow the market as a whole. It will benefit all of us. And so we started working on that pre-COVID, and then COVID put a stop on everything because everybody had more important things to do immediately. But since last year, we picked this up again with a number of European platforms. And while I can't give too much away right now, because it is actually formally launching very soon, we've spent the last 12 months standardizing terminology across all the platforms, standardizing risk metrics to give it an actual risk rating, which can easily be compared across the different products on different platforms. All of that is just stage 1. Stage 2 is then all of us coming together to be on a centralized marketplace. Because the problem with the crowdfunding and peer-to-peer industry is, when it started off, everybody wanted to be the marketplace. The problem is everybody can't be the marketplace because the market is the marketplace. And you can't, unless somebody suddenly comes in and dominates the whole market, it's always going to be fragmented. So I've seen this in financial services over the years. I've seen it in the bond markets. But basically, when these firms all come together and they start working together and you standardize things, it becomes much better for the consumer, in our case, the investors, to understand, to buy into what we're doing. And it becomes more of a mainstream accepted product. Whereas right now, we are still very much the alternative investment sector. Really? Why should we be alternative? We should be mainstream. And so what I think is going to happen is, so that's the second stage. But then what I think will happen is consolidation. And I don't just mean consolidation in terms of, firms buying other firms. What we realize is, back in, years gone by, you would have firms buying up lots of other firms and so on. The world has changed. The world is full of entrepreneurs. Every platform owner doesn't really want to sell out to another platform owner because they believe in where it's going. So the answer to this is collaboration. Work closely with a whole load of other platforms, cross-pollinate investors, cross-pollinate projects and opportunities. And that's already started happening, even with what we're doing with our partnerships in Hong Kong, East Africa, India, the Middle East. All of these things are about that collaboration, so for example, our partners, again, I can't give the name away because we're still on the verge of signing, but our partners in India and the Middle East, for example, unlike Hong Kong, which was completely opened under the Shojin name, in India and the Middle East, they've already got their own platforms. They're regulated locally. So, we don't need to buy them. They don't need to buy us. But actually, we can all work together. And then when the moment comes, we will all merge in order to list. We don't need to do it until then. So that's what I think is going to happen. A lot more collaboration leading to consolidation.
Which will hopefully be the best thing for investors. So, that's all we care about on this end of the spectrum is where can we find relatively safe places to put money. It's been very, very difficult, especially since the failures. All it takes is 1 or 2 failures in an industry and then investors become spooked. And one of the other things I wanted to mention too, investors rely very, very heavily on platforms to do due diligence and present opportunities that are good for them, because I think the majority of investors really don't understand risk analysis. They can't, and I'm speaking for myself too, because I'm sure a lot of our people who watch this are a whole lot smarter than I am. But there's been cases where I've looked at projects and I've had a very difficult time without spending hours and hours and hours of due diligence, which if I'm putting £100 into a loan, I'm just not going to do it. But I've had a lot of trouble really identifying risky versus non-risky projects. So we rely on, the platforms to really present that information to us in a clear manner, so we can invest and sleep at night. So
yeah,
I just wanted to make that point. We've been going for about 55 minutes. I definitely don't want to take up too much of your time, so I'm going to run through these last couple of questions. If anybody out there again has any questions for Jatin, please put them in the comments. We'll run through them at the end. Hit that thumbs up if you can. Don't forget to subscribe to the channel and check out Shojin's website. This is not a paid stream, by the way. This is just something I was interested in learning more about, what Shojin's up to.
Lawrence,
yes.
Sorry, just on your last comment there, I think there's one thing that definitely should be something to be mentioned on the call. When it comes to risk and due diligence and so on, one of the biggest issues in the early days of peer-to-peer was, for example, nothing against tech guys, but you had a bunch of tech guys setting up a real estate peer-to-peer platform. The wrong people were doing the due diligence, or they just weren't doing due diligence. They were just literally, connecting A with B and taking a fee in the middle, and that was just wrong. The newer approach, I call it crowdfunding 2.0. It's the approach, where we're doing all the due diligence, and we recognize that people are relying on that due diligence. And in fact, that's all part of our kind of FCA model, is that we understand people are relying on us, and the FCA is saying people are relying on you. So actually the onus is on us. But it still amazes me that people, if you go online sometimes in social media, you often see people saying such and such platform or whatever, this is a scam, the returns are too high, this must be something dodgy or whatever. And that's a real shame. People should spend time and effort researching the actual platform they're investing in, because forget the project. Yes, of course, you'll need to do some due diligence, make sure you're comfortable with it, but you'll never be able to do the level of due diligence that we do internally, unless you have 6 months to spare. You will not be able to do that, because it takes a lot of time, a lot of man hours, a lot of people are involved. So you need to do the due diligence on the platform, their history, the market, kind of how people perceive it in the market. And one of the things that people don't even realize they can do is, go see them. If you're on the fence, if you're not sure, go. We say to people all the time, come to our offices, meet the team, see how we do due diligence. Hell, spend days in our office if you want, and you can see how the process works. The whole point is that for this market to really take off, there's going to be complete 100% transparency, and that's absolutely crucial. And for that to work, and for investors to really get comfortable, and for this to become a mainstream investment, people have to feel comfortable in doing that due diligence. And so there are certain parameters. First off, if you go online, you always see platforms or companies offering investments at crazy returns, but they're not even regulated. Now, the reason they don't get shut down is and the FCA has actually said this, they don't have the manpower to shut them down. So a lot of people operate in this gray space where they're unregulated. If I was you as an investor, first of all, do not touch a firm that is unregulated. Let's just knock them out of the way. Once you know they're regulated, that's no guarantee of success. That doesn't mean that's not a stamp of approval on the project. It just means that the company is being monitored by somebody or a higher authority. So from that point, you start looking at the company itself, get comfortable, attend events, attend webinars. We have investors that sit on the sidelines for months. I mean, a couple of people have sat on the sidelines for 3-4 years, and then just come in, and because they've monitored everything we've done over that time, and then they come in and invest. It's absolutely fine. There's nothing wrong with that. So educate yourself, do your research. That kind of stuff is absolutely crucial.
Okay. Is Shojin a profitable business? And if not, when are you going to be profitable estimated?
So Shojin is probably one of the very few fintech firms that is profitable and has been profitable. So 2020, 2021, and then now our year end is June. So for June 22, we're already looking at all 3 years profitability. So yes, in short, is the answer.
I'm surprised because not many companies in the fintech world are. So that's a really good thing. Congratulations on
Do
that.
you want to know what caused that though?
Tell
Like
me, did you
it's
did
not
you
by
bet on
choice.
something big like the?
No,
Did
no.
you buy a bunch of Bitcoin when it was £500?
I should have, and I kicked myself. But no, no, that wasn't what it was. What happened was in the early days of fundraising, we would talk to firms in the UK or investors in the UK, and the first question they would all ask is, "Are you profitable?" Whereas, when we talk to our US counterparts, the US has a strong belief in this idea of growth ahead of profit, right? So build your investor base, build your product base, do all of that. We'll worry about profit later. In the UK, it was never like that. And while I had the US mentality, let's go for growth, we were faced by that so many times. We thought, all right, you know what? We've got to just get this to profitability, then we'll get to growth. So that's what we focused on. We got it to profitability. Now, what's really annoying is I talked to potential Series A investors in the US, and they're saying to us, why are you profitable? That's a bad sign. That means you're not growing fast enough.
Can't win.
I mean, come on, you can't win. You can't win. But anyway, hence we are
Well,
profitable.
I think that's a good thing, but I understand both sides of the story. So what's the biggest single challenge that you faced with Shojin since you started?
You know what? It was scale. So I'd say it was Borough that one project that went wrong. That was very stressful. But actually, you know what? That was what it was. What I didn't realize, and I've since learned that this is actually quite a common thing. As your team grows, you need to have different structures in place to enable that growth. So somebody once said you want to be like a McDonald's where everything has a process, a system, and then that way it doesn't matter how many people you add on, they all follow the process, you're done. At one point, we'd grown to 16 people quite early on. And I realized one day I didn't have a clue what anybody was doing. And myself and my business partner, I believed in this flat structure. So everybody effectively reported to me or him. We became the bottlenecks in the whole system. It just did not work. That was probably the single biggest challenge and that we faced throughout our entire history. We had to cut the team down by almost 50% so that we could rebuild the foundations and then grow again. So, and to be fair, for the last couple of years, we were rebuilding the foundation, and now we're firmly on that growth trajectory again.
Let's see here. One more. I'm going to ask you two more questions, and then we'll do a quick Q&A. Just tell me briefly. I was looking through the projects that you have. You have a project in Malaysia, which I found pretty interesting. This Muse Tower in Penang, which is offering pretty high returns of between 27 and 38%. It is 100% funded, so too late for everybody out there. But I was interesting that you were offering something in a different country. How did that come about, this project?
So when we opened our international partnerships, one of the earliest ones to open was in Hong Kong. And that's because somebody there saw what we were doing, absolutely loved it, started blogging about it, and basically we found out that they had a really big presence in the Far East market in terms of the investing generally. Anyway, the idea initially was to enable them to invest into the UK project, but the longer term goal was always to do localized deals because there's tons of opportunity in Asia. So we'd been looking out for our first opportunity in Asia for quite a while, and then this one came along. And what we absolutely love about this one is it's not a development play, right? Because that would be a very big first step, right? Because we're not there, we don't have the on the ground presence. But over the years, if you look throughout the history of real estate, it's a very common thing where if someone's building 100 apartments and an investor comes along and says, you know what, I'll take 20 of them, but you know what, I want a very big discount. The developer will sell them at a big discount because he needs to offload a good number of apartments, along the way. What that person then does is they don't pay for those 20 apartments. They simply exchange, put down a deposit, 10% max. And then they go on and try and sell them into the main retail market. So you can almost think of this as like a wholesale to retail model. If you own a corner shop and you buy a box of Mars bars, you buy 48 Mars bars in a box, but you put individual Mars bars on the shelf. That's all these people are doing. They're buying 20 units and then they're selling one at a time into the market. The idea is to sell them before you have to complete on the actual purchase, because you've sold them and now the new person completes. The beauty of that model is because of the discount you're getting and the amount of cash you had to put down, your return on capital is huge, in excess of 100% easily. So with this project in Penang, what we loved was a number of things. Firstly, it's in Penang. It's there's a fantastic real estate market there, but a fantastic economy generally, politically stable. It's one of the biggest semiconductor and kind of high tech manufacturing hubs over there. It's got a free port, all of those kind of things. But what really got us sold on this deal is our partners in Hong Kong were very closely associated with another firm that has the sole distribution rights for this massive scheme called PICC in Penang. PICC is, I liken it to something like Canary Wharf, right? So anybody who knows Canary Wharf, it's almost like a complete area regeneration, multiple buildings of apartments, offices, a railway system, all of these things coming in, and it all backs onto a lovely golf course. And these guys in Hong Kong have the sole distribution rights. Now, they sold something like 200 out of the 600 units in the first phase of the development, and they've sold them to buyers in Hong Kong. The thing that I didn't realize, which I since learned after talking to them, is Penang is a lot like Hong Kong. It's an island. It's got a very big Chinese speaking community, and if you look at what's going on in Hong Kong and China at the moment, a lot of people are looking to buy property outside of Hong Kong, but they don't want to. While yes, a lot of them may come to the places like the UK, a lot of them want to stay within the Asian region and within a Chinese-speaking community. So what these guys did was they secured the last remaining 20 units of a certain size that the guys in Hong Kong love. They're the 1,500 square foot apartments, dual aspect, and they basically secured those. We bought them in at something like a 20% discount. They're now effectively selling them one by one. Retail. They already have a track record of selling these, and that's how you get those level of returns. The level of return sounds really high. There are risks. The risk is if we don't sell them, we end up owning a bunch of apartments in Malaysia, right? So weirdly enough, we managed to structure the deal so that if we do end up holding any apartments, the developer, which happens to be one of the biggest developers in Malaysia, the developer will be lending us the money to buy them at 3.25% per annum. So we structured it in a way where we mitigated pretty much all our risks. Not all of them, because obviously the cash flow element if we do end up owning them and renting them out. But actually, the upside is so big, and so the chance, the probability of hitting the upside is so big, it's worth taking that risk. So while it's a very high return, it's not a high return because there's anything strange going on or that we found a particularly good deal. It's actually a tried and tested model throughout the world, the wholesale to retail model. That's it.
Yeah, it makes sense. Yeah, when you look at it that way. People have been doing that in the UK for a long time, so interesting chat learning about Shojin. How long will we go for? An hour and 10 minutes. I'm going to ask you one more question.
Sure.
We talked a lot about these platform failures that have happened in the past. So investors are very gun shy coming in. If somebody wants to try out Shojin, they're obviously, to be properly diversified, they're going to need quite, I would think, you wouldn't want to just come in with $5,000 and I guess you could just try one project and see how it went. But to anybody out there that's wondering, do I feel comfortable trying a new platform out? Just tell me a little bit how you protect Shojin investors from projects, making sure, I know you mentioned you do a lot of due diligence, you check on the project, you're always keeping on top of what's going on with the projects. Anything else that you want to share about how you protect investors? If somebody wants to try you out?
Yeah, so I mean, I've said enough about the due diligence process. I've also mentioned obviously that everything we earn is back ended, so it's in our interest that actually it finishes well. And we've mentioned the oversight. The other things within the model are really how we try and get extra protections in. So if you take that Slough project as a great example, as well as having a £5 million buffer, which is the profit margin on the project, sitting below us, the developer's got 725,000 of his own cash. He's also got a £600,000 personal guarantee. So what we try and do is we try and attack it from multiple directions to say, well, what could happen, right? The market could drop by 20%. All right, how do we protect against that? And then we try and bring in protections on that basis. Because we keep a very close eye on the project, really it shouldn't go off track. And we have in-house experience. We've done our own development projects. We know the kind of things to look for. We also know the tricks developers could play or contractors could play in terms of talking about the stage of development. So we keep a lookout for all of those things and really just make sure we catch them early on. The other thing is, let's say something, let's say the developer, something happens to the developer. Let's say one day he wakes up, he's decides, you know what, he's had enough, and he's just walking off the project, right? He loses 700 grand or whatever. Well, we can step in. We've done our own development. We can step in. So again, it differentiates us from a lot of other platforms. We come from the development construction world. We've been there, done it. We've had the pain and we've had the pleasure. So we know how to deal with it. I don't want to deal with it, but if push came to shove and you had to get me on site with a hard hat, I'd do it. It wouldn't be an issue.
I have an issue. Okay, awesome. We'll go through a couple of questions here and then we'll let you go because it's been an hour and 10 minutes.
Sure.
Definitely appreciate your time. Let's see here. Invest22 says, how many company shares are left? Are the share prices likely to increase or decrease? So I think we have to start out by saying that share prices don't necessarily, they're not like standard stock market shares that have fluctuating values. So I'm not sure if really that's kind of
So,
relevant question to the shares of what you guys gave out.
so do they mean the shares in the project or the shares in the
No,
company?
I think it'd be the company shares.
Okay, so the valuation of the company, actually, weirdly enough, we had a formal valuation done, weirdly enough, after we raised or launched our Series A. But it was done by a Silicon Valley firm, taking account of a lot of the growth rates in the market and things like that. They came in and said the company should be worth between 80 and 120 million pounds, which obviously we fell off our chairs when we saw that, which is great to hear. But then I'm also, I'm a Brit, we're conservative. So, we'd already gone out there and we'd started selling shares at the time it was at 49 million. So we carried on. But what we decided was, and we're happy to do that because a lot of our investors, they came in. A lot of our platform investors ended up investing in the company as well, which was great. But we're gradually moving that or the sale price up. So right now, I think we're selling at 52 and a half, and soon it will be at the end of the month. I think it's moving up to 55. Interestingly enough, in case anybody is interested, we have, or I did yesterday, I recorded a video talking about some of the ways the company's progressed since last year when we started raising Series A to really show how we spent the money. I thought that would be an interesting thing for people to hear. But it's also to share with people that haven't yet invested or who may be sitting on the sidelines thinking about it. Because actually, when you look at what we've achieved in the past 12 months, it's been absolutely phenomenal. The growth is absolutely happening. So, in answer to your question, will the share price move up or down? Well, our sale price is moving up, but it's an illiquid market. So, you can't until you have a liquid market, you don't know where the open market value is. The only time there'll be an open market value is when we list the shares. So I think that's at least a couple of years away.
Let me get
And,
back.
and also, once they register, they'll also get the update video as well. So, again, we like being very open and transparent. So we'll hold webinars and things to talk through the tranche 2 as well.
Okay, perfect. Richard McDougall, our friend in Scotland, says, do you offer an auto invest product even if £5,000 minimum remained, suggesting perhaps a chunks of £1,000 times 5 would drastically reduce investor risk? What are your thoughts on that? Do you have an auto invest product?
We don't have an auto invest just because they're not. Every project is different, and so far, I think investors like choosing which ones to go into. Actually, as you're in Scotland, you should know we've just launched something in Glasgow as well, so that one we're very excited about. But no, so we don't have an auto invest yet. What we are looking to do, however, is in order to simplify the investment process. Some people love choosing the individual projects and looking at the memorandum, attending the webinars, and so on. We've had some people come to us and say, look, I really don't care. Can we just give you some cash and you invest it wherever you like? And obviously we can't do that yet. But we are looking to launch a set of funds, 3 funds, a low risk, mid risk, high risk. That's it. And then that way we'll be able to distribute funds across various projects. So hopefully that will be coming within the next maybe 4 to 6 months. So watch this space. That's almost the alternative to the auto invest.
Okay. Let's see if there's any other interesting ones. John Morgan says the current loan available looks like it's giving the lowest return rate for previous projects. When is the next project going to come online to offer?
So we had a few available. The last couple of weeks have actually gotten really busy. Everything seems to have sold out. So the one available right now is I think the one in Glasgow. That one's actually selling quite quickly. We will shortly be launching, just like the Slough one that you mentioned, where we had 2 tranches. We had mezzanine at 14 and the preferred equity at 22.5. We've got an identical one launching in Reading. Same developer, weirdly enough, same type of scheme, a pretty new building, about 18 years old, and a complete conversion into residential. That will be launching in about 2 to 3 weeks. If you are interested, if you just register on the platform, you'll automatically get informed when these things launch. And then apart from that, I mean, we've got a very, very strong pipeline right now. We're looking at a project in Hadley Wood, in Lambeth, and there's a few others. So I appreciate the stock is quite low at the moment, but we have got a lot in the pipeline. So do check back.
Do they tend to sell out pretty quickly or get funded pretty quickly on the platform?
It varies. Some of them do. You know what? It's weird. It depends on when we launch them. Almost the day of the week, the time of the year. Is it we have a lot of Far East investors. Is there a Chinese holiday of some sort? There's all sorts of things that play into it. But some of them sell out really quickly. Some of them will sit there for a few weeks. We fully underwrite it, by the way. So, the project actually starts, even if it's not fully funded. Mm-hmm. And then we find there's sometimes a burst of activity and suddenly it just sells out. So it's really weird. We haven't actually pinned down the pattern yet. Yeah. Still working on it.
I was going to ask you about tranches. So if for some reason the second tranche doesn't get filled up by investors, you've already underwritten it, so that's going to get funded regardless.
Yeah, so what happened was when we went out to raise our Series A money, we got talking to a number of family offices. So we'd already earmarked a chunk of it for our platform investors because we want, even though it's smaller investors at 10K, 20K a pop, we want those because actually they're all ambassadors for the business. So we now have 220 shareholders around the world, which is fantastic. But we also had a chunk set aside for larger investors who would be more strategic. They'd add value in certain different ways. One of the ones we spoke to actually provided an underwriting facility starting with 5 million going up to 10 million, and they said they'll go above that as well if we want. What that means is we don't have to launch projects as early as we used to, because we always used to have to tie it up for the completion date. We don't have to do that anymore. We can get the project funded and then sell it through the platform. What it also means for investors is by the time, you don't want your money sitting there while we're waiting for completion. So this way you can come in after it's already completed, and your money starts working straight away. So yeah, everything is fully funded before. There's no risk of a project not going through because it's not funded.
Oh, okay. That's good. One last question, then I'm going to let you go, Jatin. Thank you. Paddy Gifferlan, I think is Jeff, aka Jeff. We get to know all of the people watching over the years, where they are and where they're located. By the way, we have people watching in Europe and in the States and different places in the world. So Paddy says, does FSV figure into your risk factor? So
FSV?
I'm thinking maybe that would be future sale value, maybe. I don't really know what FSV is. Do you know what that is?
I've not come across that term before. If you could ask me to write it, that'd be great. But if it is future sales value, then absolutely yes. I mean, that's the exit price. So that's a big part of our assessment of the project. Okay,
perfect. Well, listen, Jatin, thank you very much for joining. Everybody go check out Shojin, Shojin. Very Asian name, kind of samurai influence. And yeah, check out what they're doing. I think it's pretty interesting. And we'd love to have you back on in the future and see how things are going, if you're open to that, if you hopefully enjoyed it.
Yeah. Look, I love it, and I love great questions as well. So yeah, absolutely, anytime.
Do you know, one of the watchers said, "Are you sitting in a public convenience?"
Who, me?
They thought maybe the background looked with the tile and stuff. It looked like
okay, yeah. No, I was trying to find the best backdrop, and this was the closest I found to our new logo.
I never thought that when I saw that background, but I thought that was pretty funny. Yes, so just to clarify, Paddy said forced sale value, SFV.
Oh, we stress it. So we apply stress tests if that's what you mean. So we look at stress tests in various different ways in terms of if it's a project from scratch, then really you're looking at, well, if the market drops by 5%, 10%, 15%, 20%, 30%, how much can we absorb? Where do we get hit? How much loss do we sustain? And then we try and mitigate some of that. So like I said, in Slough, we managed to mitigate it by getting a personal guarantee for £600,000 just to add a bit of extra comfort into the scheme of things.
So it all gets factored in.
Yeah, absolutely. Okay,
perfect. All right. Well, thank you again, and hopefully we'll see you soon. Good luck with everything. And yeah, it was really a lot of fun. Enjoyed it. Thanks,
Thank you very much. Thanks for having me on.
Okay. All right. Speak to you soon. Okay. Bye. So there you have it, everybody. Shojin Property Partners. Yeah, I was impressed. I think Jatin has got a good business model over there, and from what I've done, research my own, looks like it's certainly somewhere you could look into if you are a maybe a higher net worth investor, because I think you would need at least 25,000. You probably want to invest in at least 5 projects to be adequately diversified. But check it out. But yes. Thanks to everybody who's here. We'll see you on Tuesday night. All being well for the crypto and the stock live stream. And yeah, we'll see you next time. That's about it. Have a great evening. Have a great weekend, everybody. Stay safe out there. Love you all. Take care. Bye.